Any company attempting to raise capital can do so by using one of three options or a combination of them. These options are borrowing, issuing equity, and internal funding. Borrowing has in itself a few different options. If 6ConEx chooses to include borrowing in its capital structure, it will have to decide between the international capital market, offshore financial centers, or the international bond market. The international capital market is a network of individuals, companies, financial institutions, and governments that invest and borrow across national boundaries. The purpose of the international capital market is to expand the money supply for borrowers, reduce the cost of money for borrowers, reduce the risk for lenders. An offshore financial center is a country or territory whose financial sector features very few regulations and few, if any, taxes. These centers tend to be economically and politically stable and provide access to the international capital market through an excellent telecommunications infrastructure. Most governments protect their own currencies by restricting the amount of activity that domestic companies can conduct in foreign currencies, so companies can find it hard to borrow funds in foreign currencies and thus turn to offshore centers, which offer large amounts of funding in many currencies. In short, offshore centers are sources of usually cheaper funding for companies with multinational operations. There are two types of offshore financial centers. These are operational centers and booking centers. An international bond market is a market consisting of all bonds sold by issuing companies, governments, or other organizations outside their own countries. Today, low interest rates are fueling growth in the international bond market. Low interest rates in developed countries are resulting from low levels of inflation, but they also mean that investors earn little interest on bonds issued by governments and companies in domestic markets. So banks, pension funds, and mutual funds are seeking higher returns in the newly industrialized and developing nations where higher interest payments reflect the greater risk of the bonds. At the same time, corporate and government borrowers in developing countries badly need capital to invest in corporate expansion plans and public work projects. By issuing bonds in the international bond market, borrowers from newly industrialized and developing countries can borrow money from other nations where interest rates are lower. By the same token, investors in developed countries buy bonds in newly industrialized and developing nations in order to obtain higher returns on their investments, although they also accept greater risk. The third option we have to raise capital is from internal funding. Revenue from our current day-to-day activities will obviously supplement some of the capital we are raising to expand internationally. The company can also look into our assets to review any that would be available for sale and no longer needed. In our fixed assets, we could look at real estate. Is there any corporate-owned real estate available? Can we sell any of this? Machinery and equipment. Can we sell something and lease it back? Can we liquidate any machinery altogether? In our liquid assets, cash. This is the easiest of all the internal sources. Accounts receivable. Can we collect any debts that are owed? Stocks and inventories. Can stocks of raw materials or products be reduced? Are we able to slow production or reschedule to reduce the stock of finished products without hurting operations? Prepaid expenses. Can insurance premiums or other prepaid services be settled in installments without extra cost? Advances to third parties. Can any loans be called in? Final category for internal funding is increasing current liabilities. Trade creditors. Would creditors be willing to grant us credit? What would the interest rate be? Taxes. Can we defer our taxes? What would the penalty be? Short-term borrowing. Can we get any short-term loans? How high would the interest rate be? There is information regarding Mexico to take into consideration while reviewing our options to raise capital. Mexico has the 12th largest economy when measured by gross domestic product and purchasing power parity. Recent surveys have shown bonds are not an important source of funding for most Mexican corporations. Each brokerage house tends to distribute its own products to its selective clientele. The Mexican Stock Exchange is a private institution that is governed by the Mexican Securities Market Act. It has approximately 250 issues of paper and 40 companies actively traded.